Okay, so time for our monthly market update. Let's begin with the US markets. Let's look at the S&P 500, ticker symbol SPX. So we started the year on a clear uptrend, and we started the year somewhere over here. And so far, the uptrend has continued, and I said a couple of weeks ago that we should expect a wave down, a retracement pretty soon, because it's obvious, after a wave up, you gotta have a wave down. We just can't predict when that retracement will happen. So it started happening 3 days ago. So the market topped at 3870 and we started our retracement down. So as of now, we have retraced to the 50 moving average, the blue line on daily candles. It's impossible to tell how deep a retracement will go until it finally bottoms. And you will never know where the bottom is until it starts waving up again. All right, so for now it looks like this is holding as a support. If it breaks this support, we could see the next support at the 100 moving average, which is the orange line, because in the last two retracements you can see that we found a pretty strong support at this level. So I'm watching this level. If we break that level, next support would be the 100 moving average. Now, people like to ask this question, why is it going down? Now, you should know by now that whether you are an investor or a trader, that is a totally irrelevant question. It doesn't matter why the market goes up. It doesn't matter why it goes down, because you will never know. There are millions of factors that drive the market up and down. Emotions, manipulation, speculation, hedge funds, you never know. But analysts always like to justify why the price moved after the fact. All right, so now that the market has come down about 1% or so, you read all kinds of reasons. So some people say, oh, it's because of the uncertainty over regulations by the new democratic government, or it's because the COVID-19 vaccination is slower than expected, or it's because of the recent mania that caused stocks like GameStop and AMC to go up. And that has caused the hedge funds to lose money when they were shorting the stock. So now they have got to sell stocks in their other positions to cover the losses from their short positions. So all kinds of reasons, it's irrelevant. It's all bullshit. All right. So all you got to do, whether you're a trader or investor, is focus on the price action. Wave up, wave down, that's it. All right. So don't ask why it happened. It's irrelevant. Now, next question would be, okay, are we still on an uptrend? Yes, we are. So how do you define an uptrend? Uptrend is defined as it depends, right? So you've got the short-term, medium-term, and long-term trends. The short-term trend is defined by the 20 and 40 moving averages, exponential moving averages, the red and blue dotted line. So as long as the red dotted line is above the blue dotted line, the short-term trend is up. As long as the 50 moving average, the blue line, is above the 150 green line, the medium-term trend is up. And as long as the price is above the 200 moving average, this red line, this grandfather line, and the red line is sloping up, it's a long-term uptrend. So currently, the trend is still on a clear uptrend, and we're going through our healthy retracement on the uptrend. Another common question people ask would be, okay, do I need to hedge my portfolio by buying put options or shorting the market, right? No, I don't do that. I only buy put options or put option spreads only when I see a change in the trend. So only when a 20 crosses below the 40 EMA, I'll start to put on some bear put option spreads. Again, if you have not done options, then forget it, right? But if you have, you could put some bear put option spreads. And of course, if the 50 crosses below the 150, that's a medium-term downtrend or potential bear market, then I put on a lot of bear put option spreads. But for now, what I've been doing, as a lot of you know on the chat group, I shared with you that when the market was kind of like a bit overextended and the VIX, the volatility index, was at the low, like this is the VIX, the volatility index. So again, remember, when the market is waving up to a high, the VIX goes to a low, because the VIX is known as the fear index. So the market's going up, people are complacent, there's no fear, the VIX is really low. So that's when I start to buy call options on the VIX. I buy bull call spreads on the VIX. And then when a market waves down, as expected, the VIX will shoot up because of fear, and then we make a lot of money on the VIX. Again, if you don't know how to trade options on the VIX, ignore this. But if you want to learn, go learn it. It's really, really useful. So if you guys have been following my chat on the notification channel, you can see on the 20th of January, I shared that I entered the VIX, right, VIX, using this bull call spread. And then, so I entered somewhere here when the VIX was at a low. And when the VIX jumped up as the market came down, I took profits on my VIX position, and it was right there. Let's see, 28. Yeah, over here. Yep, just woke up to find that the balance of my VIX bull call spreads have been filled at $1.10. So I bought it at 70 cents, sold it at 110, so 57% profit in, actually it was just 1 week, right? So really, really good way to make some money as the market comes down. So for those of you who have been following my chat group, my notifications for a couple of years, you would now see my pattern, right? So the moment I see the market is waving up, kind of like overstretched, and the VIX is very low, I buy bull call spreads on the VIX. Then when the market waves down, the VIX goes up, I take profits on the VIX and I make some extra profits from there. And if the market reverses into a downtrend, right, the 20 crosses below the 40 EMA, then I'll start to buy bear put option spreads on the market. So I can make some profits as the market goes through its correction. But for now, like I said, it's still an uptrend. So it's still premature to buy put options on the market. So I'm just going to leave it as it is. So the year started here. This was January. And right now, at end of January, we are here. So overall, the market, or the S&P, is down about 0.3% for the year. So very small retracement for the first month of the year. That's the S&P. The Nasdaq, that has mainly the tech stocks, is up about 1.7% for the year. And the Dow Jones is down about 1.4% for the year. Now, as the market goes through a retracement like what we're going through now, it is inevitable that your investment portfolio will also see a drawdown. You will also see a fall in the value of your portfolio. This is really normal. So don't panic, don't be upset. It's part of the game. See, whenever the market goes through a retracement and our portfolio goes through a drawdown, it may not feel good. It may not look good, especially if you're a newbie investor. Oh, all that unrealized profits is disappearing, or my, portfolio's going down. It doesn't feel good, doesn't look good, right? But over time, you'll realize that you have to breathe in before breathing out further. And the same is true for the markets. The same is true for your portfolio. Your portfolio has to sometimes take one step back to take 3 steps forward. It's part of the game. So again, when your portfolio goes down, doesn't look good, doesn't feel good, but it is actually good for you. Why? Because it gives you the opportunity to add more shares of your favorite companies at discounts. And as you can see from the chat group, and I'll show you in the portfolio review and watch this review, there are some of our favorite companies that are now beginning to look decently valued again, right? So from overvalued, they now look reasonably valued. Some of them are beginning to look undervalued. So that gives us a chance to keep adding shares. So during the next wave up, our account will grow in value. I can tell you that over the years of managing my portfolio, I have found that every time my portfolio goes down, it will go even higher. The same is true for the markets, the same is true for the portfolio, and the same is true for life as well. If you think about in life, none of us like crisis, none of us like problems, but we need problems in life because they make us grow as a person, they make us stronger emotionally, spiritually, right? But it also depends on the actions you take. If you go through crisis in life, you go through problems in life, and you blame other people, you give up, then you go on a major downtrend in life, or you go through a bear market in life. But whenever you've got a crisis in life, whenever you've got a setback in life, and you learn from it, and you take positive action, you always grow as a person, and you always end up more successful, happier, and healthier. So the same is true for everything in life, right? Same is true for the markets as well. So this is the S&P 500, and of course, you can't buy the S&P 500. You can buy the S&P 500 ETF. So let's look at the SPY. Now, I don't currently own shares in the SPY because I've sold all my SPY shares and I'm mainly invested in the individual companies. But I will get back into the SPY only if I see a bigger retracement. So you can see that on daily candles, like I said, on the shorter term time frame, it looks like it has retraced to the 50 moving average support. But if you look at the weekly candles, which is a longer time frame, you can see that the market still relatively looks quite overextended. Meaning to say it looks still far away from the moving averages. Remember, these moving averages that you see, they are called averages because when prices move too far above the average, it tells you that it is technically overbought. It's like a rubber band, right? You're stretching the rubber band or pendulum, eventually is gonna snap back to the moving averages, or eventually the moving averages will move up either way. Okay, so on the weekly candles, you can see that in a way we are still far from those moving averages. Okay, and you can see, for example, this wave up, wave down, wave up, wave down. So in previous retracements, we saw support at this 20 EMA on weekly candles, the red dotted line. So right now we are here. Don't be surprised that we wave down to at least the red dotted line over there at 359. So that would be my first support level and potential buy point for the SPY. Okay, but again, not buying a lot, maybe buying a quarter position. Why? Because again, it could retrace to the next level, the blue dotted line, which is 343. And if it gets even a deeper retracement down to the 50 moving average, you can see that during a deep retracement, it has gone to the 50 before. That would be 325. And that would be the third buy level. And that would be the fourth buy level. All right. So again, as far as the SPY is concerned, I'll only take positions at 359, 343, 325, and 312. Again, buying in tranches, right? Buying a quarter position, another quarter, and finding a full position only if I see a big enough retracement. So that's the S&P 500 for you. Okay, next we have got the triple Q. So this is the Nasdaq ETF, comprising mainly of the tech stocks. And again, you can see on weekly candles, it still looks pretty overextended, right? You can see previous retracements over here, wave up, wave down, wave up, wave down on the red dotted line. So wave up here, again, don't be surprised if we wave down to at least this level at 298. So again, that would be my first buy level, one quarter position on the triple Qs. Or it could retrace deeper to the 40 EMA at 277. Or even the 50 moving average, the blue line. You can see it's previously been very strong support here at 259. All right, and my last support would be 238. This coincides with previous swing high, previous resistance that will act as a strong level of support over there. So that's the triple Q. Finally, let's take a look at the Dow Jones. The Dow Jones ETF, ticker symbol DIA. And again, you can see those levels. Now, the Dow is less overextended compared to the triple Q and the S&P, because again, the Dow consists mainly of financial and industrial companies and less technology companies. So because of that, they have not rallied as strongly. They are not as overextended as the other two indexes. So the Dow, as you can see, has retraced. We're looking at weekly candles again. And again, I'm looking for it to retrace to at least the 20 EMA, 293, or the 40 EMA, 284, or to this very strong support here at 270. And finally, the last level of support I see would be 263. All right. Could it go all the way down here? I doubt it, because again, this only happens during a major bear market, right? This was the COVID crash. This was the trade war that triggered that bear market. And again, these bear markets don't happen that often. historically they happen once in 5 to 6 years. So unlikely we're going to see that big of a drop. Unlikely we're going to see a bear market, but we should see a healthy retracement. Remember, a retracement of anywhere from 3%, right, a 3% drop to even a 50% drop, a 15% drop, 3 to 15% drop is considered a healthy retracement, right? It's only when you get more than a 20% drop that's a bear market. That's a real change in trend, and that's something that could be more scary for other people. Comparing the three indexes year to date, you can see the candles would be the S&P 500 down about 0.34% so far for the year, which is the first month. And we have got the Dow Jones, which is this orange line, down about 1.16% for the year. And we have got the Nasdaq, the one in blue, which is up about 0.64% for the year. By the way, earnings season has just started for the US market. So this is the time where the majority of S&P 500 companies would announce their earnings reports. So as an investor, I look at these earnings reports to basically see, okay, sales and profits and cash flow, they are growing in line with what we expect. And we may do an update to the valuation of the stock based on its earnings. Now, having said that, do short-term earnings determine my investment decisions? No, not at all. Because when you buy a great business and you know that over time it's going to go up, whether they announce so-called good or bad earnings in the short term is pretty irrelevant, right? And in the short term, remember, a company that announces good earnings, the stock price can still drop. And a company that announces bad earnings, the stock price can still go up. Why? Because in the short term, price movement has little to do with the value of the company. Price movement has very little to do with fundamentals. In the short term, the majority of price movement is largely manipulated, whether by market makers or hedge funds, or now even manipulated by a gang of traders on the Reddit forum board that gang together and push a stock up or down. So remember, in the short term, price that you see doesn't always equal to the value of the business. In the short term, prices are totally irrational. They are totally manipulated. And here's a great example. So if you look at Facebook, now Facebook just announced record profits, way better than expected. So if you look at FB, Facebook, and in case you don't know yet, let me go to the daily candles. Okay, so this icon would be the earnings alert, right? It says earnings was announced on the 27th of January. Facebook was expected to earn 3.236. They earned 3.88 per share. So they blew away expectations, right? If you click on news over here, you can read the specific news regarding Facebook's earnings, which again was way better than expected, right? So Credit Suisse raises the price target to 330. Let's see, where was the update? That's right. So Facebook beats revenue and profit. So basically, it was great earnings. But what happened after they announced great earnings? Did the stock price go up? No, the stock price went down. So people often ask, why? Why did the price go down? They did so well. Again, don't ask that question. It's irrelevant. Because even if they announce good earnings and the intrinsic value, by the way, based on their last earnings, I have done a revaluation of the intrinsic value of Facebook, and now my valuation is between 334 and 360. And at the current price of 258, it's bloody cheap. It's undervalued, right? So logically, it's a buy. It's a buy, right? But why is it going down? One word, manipulation. Now, is this good news or bad news to us as investors? It's good news. Why? Because it's telling us that we get to buy this great company that's doing even better at a lower price. Just because people are out there manipulating it, it creates a greater mispricing of the business, gives us an opportunity to buy. So never be guided or emotionally affected by short-term price movement. Instead, let it serve you and take advantage of other people's stupidity who sell at this level, and let it serve you to add shares at a good level. Okay, so Facebook's a good example. Now, Apple's another good example. So Apple also had great earnings. Apple had the best iPhone sales in history. They reported great earnings. What happened? Stock price went down. Why? Because markets irrational, markets illogical. Is it good? Good for us. But Apple's not cheap enough. So I'm still waiting for Apple to drop below 112 to maybe 106 before I start buying shares. Because although it dropped, but it's still overvalued. Now, on the other hand, we've got companies that are losing money, that are absolute crap, and their share price has gone up 800% or 1,000%. So everyone's talking about GameStop, right? This stock called GameStop, GME. And look at what happened to the stock price, right? From $15, boom, to $483. And now it's closed at $325. If you look at GameStop, look at the fundamentals of GameStop, right? Look at this. So you can see it's a dying business, right? The revenue's going down, it's losing money, right? Cash flow is dropping, profits are declining, all right? Debt is going up. So why is a company that's losing money, that's losing value, why is the share price up like a few 100%? This is the case of pure manipulation, except that it's not manipulated by market makers or not manipulated by hedge funds, which is usual. But in this unique case, it is being manipulated by retail traders who ganged up together on Reddit, which is a forum bot, and say, hey guys, let's manipulate the stock together. So all of them basically agreed to buy like crazy. So remember, prices are driven by demand and supply. So with all this demand for the shares, right, buying, it pushed the share price all the way up. Okay? Now again, remember, in the markets, there are three kinds of people. There are investors, there are traders, and there are gamblers. Now, if you are a well-trained investor, which I hope you are, you will make money. You will always make money eventually. As a well-trained trader who trades based on technical rules and price action with a stop loss and a profit target, you will always make money. I trade with options, as you guys know. But the third category, if you are a gambler. As a gambler, you're basically gambling, right? So as a gambler, sure, you could make money for a day, a week, a month, granted maybe even a year, because you're lucky and you went in with the crowd, right? But at the end of the day, gamblers will always lose it all back, plus a whole lot more. And when people ask me, Adam, what about GME? What about these stocks? You know, these guys are gamblers, right? So how much attention do I put on this? Absolutely zero. But I'm bringing it up to educate you that whether you're an investor or trader, this is purely a distraction. Don't look at it. I'm not even interested in it. But I think it gives us a very good lesson. And the very good lesson is that prices, whether it goes up or goes down in the short term, has nothing to do with the fundamentals of the business. It is purely speculation, right? So think about it. A crap company, the price goes up like that. And a great company like Apple or Facebook, where you have got the sales going up and the profits going up and the debt really low, and there's a great company like that announcing great profits and the stock price goes down, right? Illogical, okay? So always remember that a great business will always increase in value over time. And over time, the share price will be a lot higher than today. But in the short term, anything could happen. It could go down, it could go up, it could go in circles, right? So our job during this phase is to buy shares when it gets ridiculous, when it gets mispriced on the downside. and not attempt to justify why did it go up, why did it go down. It's all manipulated. It is all manipulated, right? At the same time, if you look at a stock like GameStop, which is an absolute crap company, you know that over time it is losing value, right? It's losing value over time because sales are going down, profits are going down. It's in a sunset industry. Then in the short term, sure, they could pump up the shares through manipulation, but eventually it's going to die. And sure, you could make money on the way up, but you never know when it's going to crash. My advice, whether you're an investor or trader, would be, stay away from these manipulated stocks, GME, AMC, stop looking at and chasing the latest shiny object. Focus on your methodology of investing in great companies or trade stocks based on proven price action and stay safe. And making money is something you should do consistently over time, that's sustainable, and not just making a lot of money in the short term and lose it all eventually in a way that is unsustainable. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.